Hello, everyone, and welcome to this May 9th edition of Economic Impact. Lots of uncertainty out there, so we try to keep on informing you. And as usual, I am with our Chief Economist, Stéfane Marion. Hello, Stéfane.
Good morning, Martin.
So let's start about the talk of the town. The stock market is under pressure. Stéfane, what's happening?
Not a great quarter, Martin. We're not even done, and we're down 8% about globally, and year-to-date down 13%. Unlike previous meetings we've had together, no regions are spared right now. Everyone is showing negative returns. So a difficult start to the year, to say the least.
Lots of disparity amongst the region. We're definitely in bear market in certain areas.
Yeah, I showed you on the previous table that was a year-to-date performance, but if you look at the performance since the recent peaks, which happened late last year, some markets are already down more than 20%, so 24% for the MSCI emerging market, as well as the NASDAQ, 24%. So more than 20% means bear market conditions. Fortunately, the global economy isn't there. And fortunately, from a Canadian standpoint, down 6.6% is pretty good resistance when you think about it. Good relative performance so far from Canada.
And why is that, Stéfane?
I think the resilience of the Canadian index can be traced back to the fact that the markets that are being most punished this year are the markets that are trading that are more expensive, so higher PE ratios. And you can see on this slide that despite the 14% correction or so on the S&P 500, the market is still trading at roughly 18 times forward earnings versus Canada, which is at less than 14 times. So the gap, the spread between the S&P 500 and the S&P TSX is relatively large, which means that the S&P TSX is still trading at a significant discount. So you're being less punished in the current environment.
And can we say that the U.S. stock market is more sensitive to interest rates?
Given its composition, yes, because there's a lot more technology stocks in it, which historically are more interest rate sensitive. And Canada has less. And in a context where interest rates are moving higher and real interest rates in the U.S. are now in positive territory, you can see that as they move higher, these real interest rates, they put downward pressures on PEs. So at this juncture, there's a lot of, increases that have already happen, Martin. So we think that maybe another 20, 30 basis points is possible on real rates, which would drive down your PE ratios in the U.S. to roughly 17 times. So maybe anywhere between 5 and 10% downside if rates continue to move higher. So we need to normalize or to stabilize these long-term interest rates.
And certain sectors are even pricing, definitely pricing a recession, if not more.
Well, recession, definitely a contraction in certain sectors. For example, consumer discretionary stocks in the U.S. are down 26%. Bank stocks in the U.S. are down 24%. So that's big. That means that the market have already priced in a significant slowdown, Martin. So to the extent that the slowdown materializes and doesn't get worse than what's already priced in, you will stabilize the stock market, assuming you can stabilize those long-term interest rates.
Well, talking about rates, we did a lot of discussion about interest rate. Let's do a deep dive on a specific sector of inflation related to the workforce.
Well, since the start of the pandemic, the inflation was mostly seen in consumer prices. What central banks don't want to see is inflation in consumer prices spreading to wage inflation. And what we've seen in recent weeks is that unit labor costs in the U.S. are surging. They're up 7% on a year-over-year basis, which is something we have not seen in 40 years. So what that means, Martin, is that the central banks will be more aggressive in raising short-term rates. Now, the issue is how aggressive will they be? As they raise rates, as will the economy start slowing down. And if it slows down, inflation will slow down, will moderate. So we have to find the neutral rate that's appropriate right now. I would say we're going to 2%, both in Canada and the U.S. this summer, quite quickly, and then we will assess the situation.
And Stéfane, what's the impact on the overall margins of our corporations?
Well, the issue for corporations right now, and we know that wage inflation is a reflection that there's high demand for labor. But the problem we have from a corporate standpoint right now is unit labor costs, as you can see on this slide, are actually rising faster than output prices, so the selling price of corporations. So basically, that's putting tremendous pressure on profit margins. And the question is, how are corporations going to behave in the next few months to protect their profit margins, because the consensus of equity analysts expects profit margins to stay where they are right now. So with the surge in unit labor costs, the onus is on corporations right now to slow down the hiring pace. So instead of running at 400,000 a month like we saw in April, you have to cool down to maybe hiring pace 150,000. These are not layoffs, Martin, but you have to slow down your hiring pace in order to moderate your wage inflation to protect your profit margins.
Stéfane, no COVID slide this month, but we're going to talk about economies shutting down. We're seeing the impact.
A big one. China, 30% of global manufacturing, a big chunk of demand for commodities. Service sector, manufacturing, both showing contraction in China. Why? The Chinese authorities have this zero tolerance on COVID. They've shut down Shanghai, shutting down Beijing. That's a big chunk of the global economy. So the good news, Martin, however, is that at some point, COVID cases will decline and they will reopen. So presumably that would help limit upside on inflation. But for now, we still have this supply shock on manufactured goods coming from China, plus energy, plus food, because of the military conflict in Ukraine.
And maybe a word on the labor market in Canada?
Yeah, just to say that, like we see on the S&P TSX, some more resilient than other markets. Well, we're seeing also labor markets in Canada are doing well. If you look at the unemployment rate, wide measures of unemployment, which includes discouraged workers, Canada is just as low, or even looking at going below the US. So tight labor markets, which also argues for higher interest rates on this side of the border. Again, we're going to 2% relatively quickly. But you know what? By design, the construction of the Canadian economy in a supply shock environment where commodity prices are elevated means that the Canadian economy can absorb higher interest rates probably easier than some of our trading partners. Just think of Europe, where long-term rates are rising and the economy is likely to be in recession. So on a relative basis, I still like Canada, but we said last month that it was time to be a little bit more prudent. Raise cash level relative to benchmark, and I think that still stands for now. But maybe the peak is not so far away on long-term interest rates, which need to be stabilized to stabilize overall market conditions.
So, Stéfane, I think in conclusion, 2% on each side of the borders pretty quickly, then a pause, we'll see what's going on.
Yeah, the market expects 3%, Martin, for long-term, short-term interest rates. We think they go to 2%, and then we see what happens. Maybe we go to 2.5%, but we don't go to 3%. If we go to 3%, that would probably increase the probability of recession. That's why everyone's nervous. But let's see what happens with this combination of factors: China reopening its economy, slowdown in the hiring pace. If that's the case, then central banks won't have to be as aggressive. And that's the key to keep a recession at bay. So a recession is not a baseline forecast at this point in time.
Excellent. Thank you very much, Stéfane. Thank you, everybody, for listening. Keep sending us your questions, your comments, and we will see you in a few weeks. Take care.